Ladies and gentlemen, good day and welcome to the V-Guard Industries Limited Q3 FY23 call hosted by Nirmal Bang Institutional Equities Private Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. If you need assistance during the conference call, please take an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Prasheel Gandhi from Nirmal Bang Institutional Equities. Thank you. Over to you, sir.
Thanks, Aman, and good afternoon, everyone. Nirmal Bang Institutional Equities welcomes you all to Q3 FY23 earnings conference call of V-Guard Industries Limited. On the onset of the call, I would like to thank the management team for giving us the opportunity to host the call. From the management team, we have Mr. Mithun Chittilapalli, Managing Director, Mr. Ramachandran V, Director and Chief Operating Officer, Mr. Sudarshan Kasturi, Senior VP and Chief Financial Officer. I now hand over the call to management for opening remarks, post which you can take questions from the participants. Thank you, and over to you, sir.
Thank you. A very warm welcome to everyone present on today's call. Thank you for joining us today to discuss the operating and financial performance of our company for the third quarter of FY23. I trust all of you have had a chance to refer to our investor presentation, which was shared yesterday. We reported revenues of 981 crore in Q3 FY23, higher by 1.4% on a YOY basis. Revenue growth has been impacted by the high base and the corresponding quarter of last year. For the last 3 years, the CAGR for revenues is 15.8%. During the quarter, the South markets degrew by 5.2% YOY, while the non-South markets grew 10.5% YOY. With continued strong growth from non-South markets, they contributed 45.6% of the total revenue in Q3 FY23, higher than 41.8% in Q3 FY22. We are making sustained progress in growing our business in the non-South markets, and they are now making a sizable contribution to overall business within all our segments. Within our segment, the consumer durable segment led the growth trajectory for the quarter. In this segment, we market fans, water heaters, kitchen appliances, and air coolers. And Q3 revenues registered a YOY growth of 4.5% and 17.8% for consumer durables. This segment has now gained reasonable scale in the blend and will begin to contribute more to profitability going forward. In our electronics segment, comprising of stabilizers, inverters, and UPS systems, we reported revenue growth of 4.3% YOY and a CAGR growth of 5.8% for 3 years. In the electrical segment, comprising wires, pumps, switchgears, modular switches, we registered a growth of 1.5% YOY and a 13.2% CAGR for 3 years. Input prices have stabilized but still remain higher than the long-term averages. We are also carrying higher levels of inventory in both RM and finished goods at higher costs. We had an impact on gross margins for the quarter. The gross margin at 29.6% in Q3 is an improvement over the immediately preceding quarter, but lower than gross margin of 31.2% in the corresponding quarter of last year. The EBITDA margin was at 7.3% during the quarter and has improved slightly on a Q-on-Q basis, but remained lower than pre-COVID levels, especially in durables. There is some impact of advertisement and promotion spends which have returned to normal levels after 2 years of lower spending during COVID. With inventory levels having come down, we should see margins reverting to pre-COVID levels in the next 1 or 2 quarters. We have made substantial progress in reducing inventory back to normal levels. Inventory days for the quarter were at 92 days compared to 105 days in Q2 FY23 and compared to 134 days in Q2 FY22. We expect some more reduction happen in the coming months. We have concluded the acquisition of Sunflame in January. We have placed the initial set of team to run the operations. In the next couple of months, we will have the full management team in place and start the integration process. With that, I conclude my opening comments, and I would like to thank the team at Nirmal Bang for hosting this call, and I would like to request the moderator to open the floor for Q&A. Thank you.
Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their personal telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Anyone who wishes to ask a question may please press star and one at this time. First question is from the line of Rahul Agarwal from InCred. Please go ahead.
Hi, thank you for the opportunity and good evening, everybody. So 3 questions. First, the South degrowth is more of a base issue or you are seeing more competition there? That's the first question.
The South degrowth is mainly a base issue. Last year, Q3, the South markets had grown substantially faster. I think the recovery was faster post-COVID for us in South than non-South.
YTD is about 15.
If you look at YTD, South growth is about 15%. So we think it's a base issue. It's not a competition issue.
Got it. Maybe on gross margins, I think quarter-on-quarter we have largely stayed flat. So recovery of margins obviously is right on the corner, but my sense is, do we go back to 30-31% of pre-COVID level or should it be higher because you will have more in-house manufacturing going forward?
No, I think immediately we will look at going to the pre-COVID levels. The manufacturing facilities, for example, the fan is already online. For inverter and stabilizer, we are commissioning the plant as we speak. And there are 2 more facilities that are coming online in the next financial year. So I think it will be in a phased way when we'll get, improvement in margin. So immediately for us, we should look at going to pre-COVID levels, and then after that, in the longer term, we should look at more improvement, due to own manufacturing.
So own manufacturing takes the gross margin up. Is that understanding correct? Directionally.
Yes, directionally it will take it up. Yes.
Okay. And lastly, on the segment margins, both for electronics and ECD, I think that's an inventory problem and hence the margins are low, or is there any other reason?
We have, we had plans for a much higher growth like for example, in a category like water heaters, we had plans for a very high growth this year because for 2 years we had lost market share. Although we have regained a lot of the market share we've lost, we have not still hit the numbers we wanted to hit. So in water heaters, this is the case. So there is high cost inventory sitting in water heaters and stabilizers, which is almost maybe 25% of the overall scale. The other products, not so much. Most of the high cost inventory is absorbed, and I think this quarter onwards we are seeing some improvements.
Okay, thanks. And maybe I'll squeeze in one short thing. Demand obviously has been weaker. I mean, that's commentary across. Any thoughts on how do you expect demand to, basically pan out? What could be like a few reasons here? Like, why are you seeing demand going weak?
So I think the general consensus is that there has been sustained price increases, not only for our products, but also for fuel, also for food items and for everything. And there has been sustained increases across, so basically expenditures of every household has increased substantially. So this is a kind of a shock for a consumer, and they may be not experienced this kind of an inflation in a long time. Although India, we have a lot of inflation. This level of inflation we have not experienced in some time. So I think it will take 1 or 2 quarters for people to get adjusted and then consume again. And I think we are seeing slowly the food price inflation is coming down. So that's the good news.
Okay, thank you so much, Mithun. All the best. I'll come back to the queue.
Thank you. The next question is from the line of Bhavin Vithlani from SBI Mutual Fund. Please go ahead.
Thank you. So the question is on the margins again, especially on the electronics segment where from a pre-COVID levels of 16.5, 17, we have seen 10.8. What do you attribute to such sharp fall in the margins, and what in your view are the sustainable levels?
So I think there are two particular issues in the electronics. One is even in stabilizer, which is the largest segment, we have had small hit in margins. That I think is mostly due to the high cost inventory, issue that I talked about. Because we have to understand that in stabilizers, we have used a lot of electronic components, and we are having inventory of almost 1 year or 9 months of electronic components in some cases. So in the case of stabilizers, because of the supply chain issues in electronics, we are holding not only in stabilizer, inverters we are holding, but stabilizer as the largest segment, we are seeing this issue. We have also seen some margin pressures in the battery segment. That is primarily what we could understand is that, core battery companies, because of the higher demand in automotive batteries, are, basically enjoying better margins in the core automotive business and cross-subsidizing their industrial battery business, which is the inverter battery business. So, two large, core automotive battery brands in India, they are, aggressively discounting, batteries in this segment. And we think this is maybe a transient issue and that probably should get resolved soon.
So just a follow-up on this. So correct me if I'm wrong. 2/3 is the stabilizers and 1/3 is the inventory. 1/3 is the inverters in this segment. Have we kind of within the segmental? Is it like a loss at the EBIT level in the inverters because your commentary is more negative on the inverters? You're saying stabilizers is marginally lower.
We don't give out the product-wise numbers, but no, but the decline is almost similar. So I think there is a 4 to 5% decline in inverter business. It won't be negative, but there is a decline in the battery side as well as the stabilizer business, and both of them have declined by 4 to 5%. But we are less worried about stabilizer business because it is a like I said, high cost inventory issue and it's a transient issue. The other one is an external issue, so we are hoping that once. Of course, we have also had increases in lead. Basically, in the battery business, the lead prices have gone up, and price increases have not happened in the market by the leading, battery brands. That's the more worrying issue, and we hope that as the summer approaches and season begins, we should, the price increases will be taken and we'll move forward.
So, in your view, is there a change in the margins that we have been seeing 16.5%, 17% of pre-COVID levels to your view on the new sustainable levels?
No, I don't think so. I think at least in electronics we should come back. I think we have more. I think our work more we are doing is on the margin improvement is on the consumer durable side, where I think we need to do a lot of work on pricing transmission. In some cases, value engineering and all the other activities we have undertaken. So the results we should start seeing in the next 1 or 2 quarters. So I'm not that worried about the electronics segment as well.
Understand. Appreciate. The second question is, there is a lot of expansion underway. If you could give us a category-wise expansion that you have been undertaking, what's the kind of investments that you have penciled towards these, and the kind of incremental revenue potential out of those investments. The second is, a couple of quarters ago, you had highlighted one of the reasons for the lower margins in the durable segment is the TPW fans where you were importing and now you are setting up local manufacturing or local sourcing. When do we see that getting corrected and what, in your view, are the sustainable level margins in the durables segment?
Yeah. Ram, you want to take this?
Yeah. So I'm not sure what you are referring to by way of investment, but I suppose you are talking about the investment that we are making at the back end in the manufacturing capability. I think the investments in manufacturing are ultimately driven towards improving our competitiveness, right? So, some part of it will translate into margin improvement, some part of it will translate into competitiveness improvement, which basically means that we can price our products more competitively and participate better in the opportunity in the market, which we are challenged today. Now, the nature of investment is fundamentally happening in 4 verticals. Inverter and battery is one vertical. Stabilizer is one vertical. Inverter and battery is one vertical.
Then, we are making investments for TPW fan, and we are also making investments for kitchen, mainly in the manufacturing of mixer grinder and gas stove and, those areas. These are the projects which are underway. And these should benefit us, we should start to see the benefits, flowing through, in the case of, for example, stabilizer and inverter, it should start to flow through, from more seriously from next quarter. I think there is some flow through which has just started, but I think more of it, will start to happen over next year. I think in the case of the other three cases, right, I think the plants are going to be up and running, to reasonable throughput somewhere in second half of next year. Yeah? So that's in terms of the time frame. And I think we will benefit both ways. Margin improvement will be there. But most importantly, in some of these categories, we will be able to seriously participate, which will then mean that we should be able to grow those categories better. So, because our hands have been tied, particularly kitchen, TPW fan, battery, our hands have been tied. And, we should be able to overcome some of these structural challenges to participate, as far as this is concerned. Now coming, sorry, I forgot your second question.
Yeah, the second question was, when you partly answered it, like the durable margins, when do you see it back to
the durable, durable margins have multiple issues. I think in the case of TPW, in the case of ceiling fan, we are hoping to, get back to our historical margins, maybe in the upcoming quarters, once we see, how the energy efficiency plans pricing is translating into market. Yeah, I think we should be able to see that, and hopefully, I think, maybe quarter one of next year, partly quarter four of this year, and then probably, quarter one of next year, I think we should be able to see the picture back there. On TPW plants, while our own internal manufacturing capability will take some time, I think what has also simultaneously happened is, the freight rates have got normalized, and some improvements, to the extent that we are importing, we will be able to see. I think TPW margins have got a bit better from where they were. But I think normalization is, maybe another 6 months away there. Yeah. Also, what happens, most of the, consumer durable businesses are seasonal, and the timing of the, improvement, should coincide with the season if you have to see the impact and benefit of that. In the case of water heater, right? In the case of air cooler, I think margins are coming back, and I think, we should see, the upcoming quarter, I think, we should see the margins normalize. In the case of water heater, I think water heater, what has happened is, it's seasonal business. The season has not gone well, and therefore, what has happened is that, we are running behind plan, although we have regained our lost market share. Now, on a higher plan, the inventory that we had procured, right, has, will be extending into Q2 of early Q2 of next year also. So I think that is where, we will be taking some pricing corrections there on top of, the commodity easing out, and we have some, value engineering and other efforts which are underway, so that, we are able to restore margins. I think on a replacement basis, we should be able to restore margins, by the time we get into the season. Consumption basis, I think, it's actually what, when, from a timing point of view, when it will reflect in our P&L, I think that's something, is looking now like a Q2 of next year. Yeah.
Thank you so
So
much.
water heater will be the slowest, right? Because, it's, the one big challenge that happens, right? Any pricing transmission in seasonal category typically is coinciding with the commencement of the season, which is one of the reasons why in battery, the margins, earlier Mithun was talking about the, lead prices started to increase towards the end of the season last year, right? And therefore, as we exited the season, the margins started to drop, and, I think the markets have not passed on because it's not conducive to correct prices off season. So we are hoping that, some correction in some of these categories will happen as we enter the season also.
Great. Yeah, thank you so much for elaborate answer.
Thank you. Participants, please press star and 1 to ask a question. Next question is from the line of Renu Baid from IIFL Securities. Please go ahead.
Yeah. Hi, good evening, team. My first question is, given that now, probably the festival, everything is over, we have winters also approaching towards the end. How are we looking at demand outlook for summers on the backdrop and sufficient inventory of the non-BE form fans already in the system? So if you can give some input in terms of the demand outlook, and especially in the fan segment, ahead of the season where sufficient inventory of the old fans have been done. And also a preparedness on the range which is there.
Yeah. So I think V-Guard has been more proactive in preparing the transition into BE range. Put it in context, we had very little inventory of non-BE rated fans, by the mid of November. I think by 15th of November, we had almost sold out whatever non-BE fans we had, because we had planned the transition and we had stopped production of these fans earlier. But of course, that is only our story, but the other companies in this category have continued to produce these products and we continue to, heavily discount and sell them in the market. So that overhang will be there, but our own distributors are very, very lean with inventory, and we are ready, and we have already started to supply. We are one of the first to start to supply the new, fans, be it 5-star or 1-star or whatever, in the market, right, and with the new price list and all that. So we are, but definitely we will have an issue in the month of, we had an issue in the month of January, because like you said, most companies have, heavily discounted and dumped these products, and retailers will be busy selling them before they start picking up. So I think we will see maybe demand picking up maybe end of February for fans. Our numbers have not been bad, but they are less than planned. But I think if you ask me, we are in a better position because we had little less of the, low star rated models. But wherever we have, common distributors or wholesalers, we have a problem because they're all stuck with, inventory of other brands. So they will be trying to liquidate that first. So I see this, sale happening maybe by end of Feb or beginning of March, we should start to see, because that was almost given them 60 days to sell out, these old, non-rated fans.
Right. And so what is the kind of price hike that you have taken for this new range? Has the entire cost of transition been passed on, or it would be done over phases in the coming season?
Yeah, Ram, you want to answer this?
I think we have, communicated, price corrections in line with the industry. I think it should overall average, somewhere 6 to 8%. Higher in the premium segment and lower in the popular entry level segment, right? Maybe at, the premium level, it is also going in some cases to double digits. So this is more or less we have taken price increase in line with other players in the market. I think the pricing transmission, I think we will have to wait and see, at what pace this is going to happen. But I think almost all players in the industry have communicated the price revisions, and we are hopeful to realize fully what we have initiated. Yeah. And this will cover basically the increase in material cost, consequent to the shift to energy efficiency.
Got it. The second question is on the large scale appliances, especially for the acquisition of Sunflame. This is a repetition from the previous call, which was acquisition. So, can you just help summarize? Now, though we're in the initial phase of completing the acquisition, but what are the key strategies and the key integration targets that you would like to put on place for the initial 2 to 3 years in terms of integration and ramp-up?
Yeah. Ram, you want to take this?
Yeah. So I think, we just closed this transaction around, on 12th of Jan. And, we just 20 days, it's just 20 days after that. I can give you some sense of, at a high level, what we see as the key levers, that we can continue to, we can leverage. But I think detailed plan and outlook and view, I think, we will prepare, once the new management team of Sunflame will come into place, right? And which is still work in progress. So right now, with integration, we have a, crack integration team which we have put in place, till the, the long-term operating teams, will move in. So, now as far as the growth levers are concerned, I think there are multiple growth levers for Sunflame. I think, South is a huge opportunity for Sunflame, and Sunflame is underrepresented in South. Yeah. E-commerce and organized retail, where the organization and the business system, that's something that Sunflame can leverage. I think Sunflame brand shops also, for what I would say, supporting the sale of hoods and hobs, these kind of is also an very interesting opportunity in space. They have 8 outlets and can be scaled up. So these are some levers. I think Sunflame has been doing most of its general trade business on cash, and I think there is a lot of opportunity to expand the network. Since I think they have been risk averse when it comes to going to market. So these are levers, significant levers that are available. And I think there is also opportunity to, transpose the knowledge of both the organizations at the back end and to leverage, the, sourcing capabilities and make capabilities on both sides, yeah, which should benefit both the portfolio. So I think these are the broad levers. But I think, we will probably, let us say, somewhere in the June quarter, I think we will have a better view, having done some more serious work to assess the opportunities and priorities and, put resources on the ground to drive the levers.
Okay. And lastly, just a specific question for Darshan sir. If you look at the electrical segment, there the margin was much better than the rest of the other segments, with a slight improvement there. So, did that also include inventory gains in the cables and wire business with the commodity price inching up towards the end of the quarter? And if yes, approximately what portion of the segment margins will be led by inventory gains?
Does it include stock gains? No, that's not the point. But it's the margins in wires have been pretty stable, except when there was a significant drop in copper. That impact we took in the last quarter. It's just that the margin compression or the margin gap is higher in durables and electronics.
Right. So the margin in the 8.5% kind of margins in this activity is also driven by better performance, probably performance of your switchgear systems and pumps portfolio, or it would be or cables and wires driving this improvement?
Yeah, the wires is making steady margins, and it's fairly steady business. Switches, pumps less impacted by the margin squeeze.
Some margins are impacted, but it is lesser than what durables have been impacted. The impact on electricals is less. Yes.
Just one more point I want to make, right? The electrical business is a business, which is stable, steady around the year, right? So, I think margin recovery, is quicker and faster because it's a 12-month product, right? The material is also getting consumed faster and because it's a 12-month product. It's the consumer durable segment and to some degree the electronic segment where, the sales are seasonal. So, depending on the timing of your inventory purchase and the quantum of inventory, right, it takes longer to consume. And for example, like, last 3-4 months, right, from September onwards, the sales have been, lower than planned, right? So, our, expected, what I would say, consumption of, high cost inventory has not happened, right? And it has carried forward longer. I think, some parts, it is like that, and, where last 3-4 months, slower things have happened compared to plan. Although, if you look at last year YTD, it's still 22% growth. But I think internally, we expect to do better, and, that has not translated because of the change in sentiment. So that's explaining some of the inventory, and, that is amplifying the, issues in seasonal categories, because the consumption of the material is happening, more in the season, and and that's when it's going to go out. And also, any pricing action also can happen to the season. Right? So these are the challenges. Whereas in the case of wire switches and here, transmissions are fast because it's round year business, right? So the cost increase also with a lag of 2 or 3 months, you will see hit the business. Right? So broadly, I think, you should see it like that. It's, the margins in electrical are better.
Which we have, which is that be fully absorbed by the end of March quarter, or that will continue for April, May as well?
I think water heater will take longer. I think some part of electronics can go into June also. So electronics, we have 6 months to 1 year, in some cases, right? So
Right.
Yeah.
Sure.
But I think, what you will see, what you will start to see is that, the blended margins, every quarter will start looking up slowly, right? For example, November or October, right? November was our bottom. December was better. Jan will be better than December. Like that, it will slowly keep inching up, right? And as, more and more categories participate, this will keep moving up, rolling margins will keep moving up.
I'll just say. So I think what we are saying is that we believe the margins have bottomed out and we will see sustained improvement. Now, like otherwise, the question of high cost inventory, it's more or less what Ram mentioned. I think most of it is over. Some will linger on like water heaters and electronics, but others will be more or less over.
Got it. I'm not sure if I can ask one more. Any indication of the volume growth in cables and wires and in the fans portfolio?
We don't give product-wise numbers, but we can say that the performance in wires has been good. Like Ram earlier mentioned, it is also due to the fact that copper prices have gone up. So in the expectation of price increases, dealers have upstocked also. So, some of the volume growth has come from that as well.
Got it.
Fans volume growth was slower because there was this churn on moving from the old regime to the new regime. We unfortunately did not have much inventory of the old items. So our numbers look little less than what others would have done. Because we had less, dealers were buying only the old items because they were available for a good discount. And the difference between the old price, to the new price is also like what Ram mentioned, 6-8%. Plus the discount. So there is a huge gap, so which the dealers have, taken advantage of.
Sure. Thanks so much for input. All the best. Yeah.
Thank you. The next question is from the line of Aniruddha Joshi from ICICI Securities. Please go ahead.
Yeah. Sir.
Aniruddha, you're not audible. Please use the handset, please. There's a lot of disturbance in the line.
Yeah, is it okay now?
This is also not clear. Please use the handset, Aniruddha.
From handset only. I still so what is the Sunflame 9 months FY23 versus 9 month FY22 performance? And because we have seen many kitchen appliances companies also getting impacted, which had really relation with fan issue also. So how is the performance of Sunflame? And secondly, how has the water purifier done in this quarter on a YOY basis?
Yeah. Okay. Ram, we will not give any specific numbers, but we can give some colors. Ram?
I think from what I understand, I think it's broadly flat. There is some decline of 3-4%, which is driven by the institutional business. The institutional business, I think there have been some changes in Income Tax Act, which has, affected the gifting business. So there is a significant drop in the gifting business. So I think that's where, there is a hit there. But minus of that, I think, it's almost flat. Something is almost flat, maybe 2 or 3% down. The big chunk is, the institutional business where, the institutional customers have stopped buying because I think they are required to, there's some changes in the Income Tax Act and, that require, GST and, to be charged and, some audit, some trail is getting created on the gifting. So companies who were typically buying, for gifting, they have stopped buying. So that's got a drag of 20% on the overall constraint business here. But I think the core constraint business is almost flat, maybe plus or minus 1%. Top of mind, that's what I remember. Is that clear?
Yes, clear. The last question, basically, what I'm saying is that overall, maybe 9 months the business is down by about...
There's a lot of disturbance on the line. May I request you to please reconnect from a different device? Thank you. In the meanwhile, we'll move on to the next question. That is from the line of Rahul Gajare from Haitong Securities. Please go ahead.
Good evening, gentlemen. Thanks for the opportunity. I've got a couple of questions. First, congratulations on the Sunflame acquisition closure that you finished in Jan. Now, you invested almost 680 crore rupees in this acquisition. You are looking at adding more manufacturing. Could you indicate to us the kind of CapEx that you are doing in manufacturing so we know how to set up the balance sheet from here?
So Sunflame has, one large manufacturing facility, which I think only some 50% is utilized. They have about 150,000 square feet of, large plant in Faridabad, where only half of it is utilized. So, and they have one more factory in Bati, which is mothballed, it is also about 30,000 square feet and also not utilized. So we have almost, almost 100,000 square feet of, manufacturing space ready with all licenses, everything. So I don't see a CapEx investment for factories happening in Sunflame for at least 2 to 3 years. I think any CapEx will be mainly for molds and dies or any new SKUs we launch, and that may not be that large.
You also mentioned about adding more capacities in V-Guard.
Yes, so V-Guard kitchen, so I think our CapEx, like what you have mentioned, is we will spend between, 50 to 70 crores annually, every year, and that will continue to happen. And we have done that for the last, the last year, this year, and even next year, I think a lot of the CapEx will happen. So that's how you can look at the balance sheet for V-Guard.
Okay, and
the manufacturing, what we talked about, which will fall under this.
And after this, how much of your sales come from own manufacturing and how much will be...
There's a slight airy disturbance on the line. Is
it better now?
Yes.
Yeah. So I want to know, with this entire Sunflame manufacturing and adding capacity in V-Guard, how much of the total revenue will come from your own manufacturing?
So I think for us, close to 65-70% will come from own manufacturing. That's what we see. And Sunflame, I think, already has, Sunflame is also about 2/3. So roughly 65% is own manufactured. So it is going to remain between 65 to 70% for the combined entity. And probably in the next 5 years, probably go to about 75%. And we will still continue to work with some vendors in some cases where, we're buying certain products where we find it better to, trade than to manufacture.
And, one of the reasons you indicated about, having low margin on the consumer division is input. From what I recollect, I don't think your inputs are very high. Maybe 2-3% is what you import. Correct me if I'm wrong on that import numbers.
So the margins in consumer durable is low because what Ram had mentioned is in kitchen, we are working with Indian outsourcing vendors. So when you work with Indian vendors or even import vendors, they also have their own margins. So it's not because of imports. The import issue is mainly for fans, which was the pedestal and wall fan, which is now largely resolved. For the other segments, the issue on margin is also because our competitiveness is not there. That is what I think Ram was talking about in terms of putting up manufacturing for kitchen. So for example, we are selling induction cooktop, gas stoves, mixer grinder. These three are roughly doing about 130, 140 crores of revenue. And we believe we are not competitively pricing the product in the market. That's what he was talking about.
My last question is on certain bookkeeping questions. I see cash of almost 130 odd crore rupees in this. Could you tell us what is the cash level right now?
Sudarshan?
Sorry, cash should have been close to 400.
So that is as of 30th December, is it? Current investment and cash would be closer to 400, 450 odd crore. But what would be this number now, with this Sunflame shares?
We've used the cash for the acquisition.
So what is the cash balance now?
About 50 crores.
50 crores or something like that. With the cash.
Thank you very much, and all the very best.
Thank you. A reminder to our participants, please press star and 1 to ask a question. The next question is from the line of Nirav Vasa from Anand Rathi. Please go ahead.
Hello, sir, and thank you very much for the opportunity. Let me congratulate the entire team for successfully executing the Sunflame acquisition. My queries are pertaining to that. So, sir, would it be possible for you to share how the funding has been done and what is the amount of debt which has been raised and at what cost?
Yeah. Sudarshan?
Yeah. We have taken debt of 275 crores. The balance 400 crores was through internal accruals. And this debt comes to us at slightly less than 9%, 8.95, 8.98.
My second question, sir, so maybe because the transaction was executed in January, so the February and the March revenue would be booked would be consolidated. Is that your assessment?
Yes, we will consolidate Sunflame from January onwards.
January onwards. Thank you, sir.
Thank you. Next question is from the line of Harshit Kapadia from Elara. Please go ahead.
Thanks for the opportunity, sir. I just wanted to check with you in terms of volume growth, if you can highlight all the three in the 3-year CAGR.
Sorry, volume growth for?
For all the three segments.
Okay, can we...
I'll let you calculate and tell you.
Okay, what's your name, please?
Harshit Kapadia from Elara Capital.
Elara, okay, so we'll get in touch with offline on this. We need to come back on.
Okay, sir. Thank you, sir. That was my question.
Thank you. The next question is from the line of Achal Lohade from GM Financial. Please go ahead.
Yeah, good afternoon. Thank you for the opportunity. Just wanted to check in terms of the outlook. On one hand, we are seeing an element of slowdown or slack in demand. So how do we see next couple of years in terms of what is the growth outlook one could have? I'm not asking for specific guidance, but can we go back to that high teens kind of a growth, or you think this is some time away for us? This is ex of Sunflame. Obviously, Sunflame will have data, but ex of Sunflame, I would like to check.
I think, what we've been seeing is right from June onwards, we are, witnessing slowness in the market, and that is coinciding with the increase in rate. So, whenever there is a high inflationary environment, it has two things. One is it increases the fear in the minds of consumers to spend because their monthly household expenditure has gone up significantly, be it petrol, food, whatever it is, it's gone up significantly. And the second thing that happens is the increase in interest rate sucks the liquidity out of the market, be it retailers, wholesalers, distributors. Banks are not lending like, last year banks were flushing the trade with money. Today, maybe not be very easy to, get financing these days. So I think we are entering a high interest rate cycle, and last time what we've seen is this is going to play out for some time until we start to see a reduction in the interest rate. So that's my answer to you. So as soon as we see, reduction in oil prices and we see reduction in inflation and reduction in interest rates, I feel that demand will come back strongly. So I think it's a cyclical thing. Nothing much, we can do about it now.
And with respect to, to counter that, obviously the distribution side, if you could elaborate, where are we in terms of the target, and how do you see that over next 2-3 years in terms of non-South?
So we are going as planned. Even you would have seen in this quarter, non-South markets have done well, and that shows that our expansion work is going on. We will continue to grow, expand, and all that. But we have to understand that we also have a South where we have very high market share. And that's where we probably face some headwinds because we probably can't grow there without the market itself growing, because additional opportunity to grow distribution South is limited for us. Of course, Sunflame can grow, but for V-Guard brand may be slightly challenging because most of our products we have very high market share in South.
Understood. The second question I had was with respect to pumps business. Can you help us understand how the pumps in terms of the momentum has been? Are you seeing any improvement there, or it's just languishing as it was earlier?
So pump for business continues to be under pressure. We are not as badly impacted like the agricultural pumps. We are more in residential pumps. But even the residential pumps demand has been impacted. I also think it's to do with the fact that we have had very good rains, very good monsoon. Excess rains in most places. So I think till we hit the pump replacement usually happens when there is a reduction in water table. So what happens is, pump is largely a replacement market. New demand is also there, but it's largely a replacement demand. So if there is significantly high water table levels, the requirement for pumps is low. So we are hoping that this summer is going to be a strong and long one. And that should, kickstart the demand for pumps. As of now, it is continuing as it is. It's nothing, not doing too well. Margins are also slightly impacted. But that's as far as the pump is concerned. So it's not, there is not much of difference from what we updated in the last quarter.
Right. Just a clarification there. That we were told by another competitor is that there is an element of aggressive pricing for the pumps. So can you give some more sense on that? Are you seeing aggressive pricing with peers or not yet?
Yeah, I think so. This is because of the other thing, right? So when there is lack of demand, you are going to have aggressive pricing, right? So it's a demand and supply thing. When there is more supply than there is demand, there is going to be competitors who are going to cut prices, and because some of them have to, liquidate their inventory and so on and so forth. So I think this is something that we've seen before also when the demand is poor. This happens. One more thing I'll tell you, during COVID, what happened is 1 year of COVID, first year of COVID, the pump demand was very strong because all these smaller pump companies in Coimbatore and Gujarat, they did not supply. Now all of them have come back in full force as well. So there is obviously that also playing out. But I think we'll wait and see what happens. So yeah. So obviously with the lack of demand, pricing is also under pressure. Or rather, people are not taking up pricing. The increases have not been passed on.
Got it. Thank you. I'll come back in a few for the follow-up. Thank you.
Thank you. The next question is from the line of Keyur from ICICI Prudential Life Insurance. Please go ahead.
So I just want to understand in the backdrop of the macro environment you mentioned about inflation and demand slowdown. So now when we see our RM cost coming down, does cutting the price help improve the demand, or it is better to get the margins, get demand here. Basically, your thought in this context between, say, maintaining the margin or improving the margin versus keeping away margin to improve the demand.
So I am a firm believer in not cutting price to improve, sales, because that's a very short-term thing and that can be done by anyone. But however, all of my peer companies don't believe in the same way that I do. So some of them will resort to this, this type of tactic. Ram, anything you want to supplement?
Yeah, because I think the margins are stressed for all companies. Okay, and I do believe that there is limited room for companies to cut prices from here. In fact, I think you will see price tweaking happening right here and there. 1% tweaking will certainly happen, is what I believe. As we enter the season, because most people have not been able to do much. Much of the particularly after February or March of last year, no price increase has happened, and the commodity continues to increase in mid-May, June. Then it's now slowly easing, right? Also, I think, even if the commodity price, the easing is fully flowing into P&L, I think it will only help companies to get back to their long-term rate. I think business has normalized, right? Business spending has normalized. Travel is normal now. ATMs are slowly getting back to normal. I think it's not going to be practical to expect that companies will respond cutting prices. And also, I think 1 or 2% or 3% price cut is not going to trigger consumer demand, right? I think there is not appetite issues that start in our kind of product portfolio, and I'm seeing this even 6 years. So I would be very surprised if they would resort to that, and I also think that it will have less scope to increase demand. I think demand increase will happen based on macros. Yeah, I think as confidence comes back and as the inflation is across the consumption basket, right, is flattening. So I think we will have to wait for that.
And this last question. So, any divergence in demand as, say, rural versus urban, or say regions, north, south, east, west, any divergence are we seeing?
There is a bit of pressure on small town, rural and entry-level segments, right? So that is pretty much there, and that's been visible from somewhere around, I would say, August of last year, right? So that is pretty much there, and it continues. Geographically, I think it's by and large, to my mind, it's by and large fine geographically.
Okay, so now you are saying rural?
Yeah, I think small town, rural, entry-level customers, I think that segment still there is pressure.
Okay, understood. So thanks a lot and all the very best.
Thank you. The next question is from the line of Bhavin Vishwan from SBI Mutual Fund. Please go ahead.
Thank you for the opportunity again. So this is a follow-up to the earlier comment you mentioned about unorganized. Could you also highlight about, besides the pumps, which are the other segments where you've seen unorganized come back with engines and that kind of taking back some market share, resulting in slowdown?
Pumps is the only category in our industry where we still have a large presence of unorganized, and that's very strong. If you look at other, product segments, is largely, consolidated into branded products, feed wires, water heaters. Of course, there is unorganized in it, but it's not like, people who are buying the, a branded wire cable, very unlikely to buy a, unbranded product because he's getting it cheaper. But pumps, it's not like that. Pumps is more like a cottage industry. There are very strong local brands in each district, and so on and so forth. So, and maybe the awareness of people is less. People rely more on the retailer, or the plumber and so on and so forth. Only in the pumps, I think this issue is more present. I'm sure unorganized is there in all the other categories, but I think over the years they've all, reduced their activity levels.
Sure. The second is on the raw material. We have seen some amount of catch-up that has happened. As aluminum, copper prices have gone up. So for the bill of material index that you track internally, what seen over the last quarter means, like, if you take plan as an end, then this is what we saw in September, and what kind of increase that we have seen?
So it's difficult to say on a blended basis, but I think copper has gone up significantly high, and aluminum has also gone up. There are certain other things that have not gone up, like steel and all that. So I think still, if we start to look at replacement, we should start to see some improvement, and that's what is making us confident about talking about improving margins going forward. So we'll wait and see. Things are not fully settled, so we'll have to wait and see what happens. But yes, there is also some price increases that has not happened, and we are going to, as we are approaching summer, we are going to push through some pricing also.
This last question. While I understand you're not giving category-wise revenue numbers, but just to understand more directionally, some of the categories which were fast-moving last year, if you could give us a YOY growth number for the quarter for fans and water heater, please.
We'll probably share that offline. This is Bhavin, right, from SBI Mutual Fund?
Yes.
We'll share it offline.
Thank you so much. These are my questions.
Okay.
Thank you. The next question is from the line of Khadija Mantri from Sharekhan. Please go ahead.
Hello.
Yes, please go ahead.
Good evening, sir. So my question is regarding Sunflame Enterprises. So in the budget, basic custom duty on electric kitchen chimney has been increased from 7.5 to 15%, and the duty on heat coils also has been reduced. So will it have any impact on Sunflame?
Yeah. Ram, you want to take this?
Yeah. So, yes, I think Sunflame has a large chimney business. Having said that, Sunflame has started to manufacture chimneys, and over the last 4-5 months, they are slowly stabilizing output. It's quite possible that there may be some, near-term impact on the chimney business, because it's presently dependent on imports to some degree, but I think, it's going to shift to, fully to own manufacturing pretty soon, or significantly to own manufacturing pretty soon, yeah. Because they are just, month-on-month ramping up the production output.
Okay, sir. So currently, how much of it is imported? I mean,
it's too early. I wouldn't have that kind of sense. But I think that, there is maybe there is a smaller portion which is domestically sourced, and there is a larger portion, which is imported. And I think, it's just a matter of 3-4 months, because, the plant is already up running, and, they took the pilot output about 4 to 5 months back. And, they are scaling the throughput month on month. So I think, even if there is any impact on Sunflame, it's going to be, transitionary, maybe, whatever inventory which is being in the system and whatever POs that are in pipeline. I think, probably they will switch over to domestic manufacturing, all domestic sourcing pretty soon, except for maybe some premium models, This might mean that some, I would say that 6 months down the line, maybe not more than 15% of the revenue may come from, imported chimneys. That rest will all be manufactured, in the factory.
Okay, sir. Thanks for the explanation. And my next question is regarding the capital employed numbers. So if I see the unallocated capital has gone up on QOQ basis from 400 to about 700 crores.
So Darshan, you want unallocated capital? We'll come back. Okay, we'll answer that later. We don't have the number with us right now.
Okay, sir. No issues. Thank you so much.
Thank you. The next question is from the line of Amish Vora from Harsh Financial. Go ahead.
Hi, sir. Earlier you mentioned that our manufacturing base contribution would go to around 65, 70 or 75%. So just from a longer term picture, what could be our blended EBITDA margins be in, say, 3 to 4 years, say?
So we obviously don't give out guidance on EBITDA margins, but our hope is that the manufacturing push will help us to improve gross margin and consequently EBITDA margin. But first, we have to get back to pre-COVID EBITDA margins before we talk about, moving even higher than that. So that's our immediate focus, to restore margins to about 10%, which was our pre-COVID margin.
Yeah, I understand. I'm not asking for any number actually, but then just wanted an assessment. In the past you have been saying that, we would move to South and non-South mix to 50-50, and you executed that well enough. From a longer term picture, I was just assessing that if the manufacturing base goes higher and, we pass the margin level of the pre-COVID, say from 4 to 5 years picture, would it be around teen levels? We can achieve that number or something like that?
I think we prefer not to make any comments on that. But I've always said that we would like to improve, 1% every 2 years. But for that to happen, first we need to get back to my pre-COVID margins and then, work on that. Of course, once Sunflame comes on board, Sunflame margins are higher than V-Guard, so some impact of Sunflame will also flow in, to the blended markets.
Just one point I want to make, right? Say on behalf of the business environment is pretty volatile, right? I think, it's, even for example, short term, we are projecting, sometimes, there is revenue slippage and, inventory expense. So it's a bit hard, and, pricing transmission is still a struggle with some, haziness on certain demand, right? So I think it would be sensible to say that, we would like to see the business normalize. I think, once the business normalizes, I think we should be able to continue on our track of being able to improve, right? But I think the foundational normalization of business that you have to get, so business margins, right?
Absolutely agree with you. And all the best with the future, sir.
Thank you. Ladies and gentlemen, that will be our last question for today. I now hand the conference back to the management for the closing comments. Thank you, and over to you.
I would like to thank the entire team of Nirmal Bang for helping us to host this call, and thank you.
Thank you very much. Ladies and gentlemen, on behalf of Nirmal Bang Institutional Equities, that concludes today's call. Thank you all for joining us. And
please subscribe and press the bell icon to never miss another update.